The venture capital scene is heavily concentrated in Riyadh, which has become a magnet for both local and regional funds. Leading firms include Raid Ventures, an early-stage firm with a strong focus on the MENA region. Its portfolio demonstrates a keen eye for fintech, with notable investments in companies like Lean, an open banking platform, and Tabby, a buy now, pay later service, indicating an appetite for ventures that are modernizing financial services in the region. 36. Impact 46, a CMA-authorized asset manager specializing in Saudi alternative investments. It invests from seed to Series A and beyond, and notably operates a dedicated fund for the fintech sector, signaling a specific strategic interest in this area. 36. Other key VCs. The ecosystem is further enriched by firms such as Khwarizmi Ventures, Merak Capital, and Sidra Ventures, which are actively funding early-stage technology companies across various sectors. 36. Alongside the formal VC industry, Saudi family offices are an increasingly powerful and professional force in the investment landscape. Historically focused on traditional asset classes like real estate, these multi-generational wealth managers are undergoing a significant evolution.
The next generation of family members is taking a more active role in investment strategy, driving a clear shift towards digital assets and long-term sustainable ventures. This generational transition is leading to a greater appetite for investment risk and a focus on innovation-driven industries like technology and fintech. A prime example of this new model is the Al family office.
Based in Riyadh, this firm has adopted a sophisticated, venture capital-style approach to its tech investments, focusing on pre-seed, seed, and pre-Series A rounds. Their stated areas of interest include B2B SaaS, PropTech, and Islamic fintech, demonstrating a clear alignment with the opportunities presented by blockchain technology. Critically, the family's parent holding company, Ajlan and Amp, Bros Group, explicitly lists blockchain as one of its target investment sectors, making it a highly qualified and strategically aligned potential partner. For MB589 and MG589, this ecosystem offers a more accessible entry point than the PIF. Engaging with a firm like Raid Ventures or the Al family office could provide not only capital, but also invaluable local market knowledge, strategic guidance, and introductions to key corporate and government stakeholders. The pitch to these entities should be a hybrid of the PIF and Western VC narratives. It must present a compelling, high-growth technology investment opportunity that is also firmly grounded in the economic realities and strategic priorities of Saudi Arabia's Vision 2030. 2.2. Qatar, a hub for regulated digital asset innovation. Qatar has adopted a distinct and deliberate strategy for engaging with the digital asset economy. Rather than pursuing an all-encompassing, open-ended approach, it has meticulously crafted a robust and highly specific regulatory framework designed to establish the nation as a premier global hub for the tokenization of real-world assets. This strategy, driven by the Qatar National Vision 2030, prioritizes financial stability, investor protection, and controlled innovation, creating a predictable and attractive environment for enterprises focused on building the next generation of regulated financial products. 52.2.1. The QFC Framework, a focus on asset-backed tokens. The cornerstone of Qatar's digital asset strategy is the comprehensive legal framework enacted within the Qatar Financial Center, QFC, on September 1, 2024. This framework, which includes the Digital Asset Regulations 2024 and the Investment Token Rules 2024, provides absolute clarity on what is permissible within its jurisdiction, effectively creating a specialized regulatory sandbox for asset tokenization. The most critical element of this framework is its clear classification of digital assets into two categories: permitted tokens and excluded tokens. Permitted tokens are defined as digital representations of verified, real-world assets or legal rights. This category is specifically designed to cover investment tokens, which represent ownership in financial products, real estate, sukuk, or other tangible and intangible assets. Excluded tokens explicitly include decentralized cryptocurrencies, such as Bitcoin, algorithmic stablecoins, and central bank digital currencies, CBDCs. These assets are considered substitutes for currency, and are deliberately kept outside the scope of the QFC's digital asset regulatory framework. This distinction is fundamental. It signals that Qatar is not interested in attracting speculative cryptocurrency trading, but is exceptionally keen on attracting businesses that can provide the technology and infrastructure for tokenizing the real economy. Any entity wishing to engage in activities related to permitted tokens, such as token generation, custody services, or operating a token exchange, must obtain a license from the QFC Regulatory Authority, QFCRA. This licensing regime ensures that all participants adhere to high standards of security, consumer protection, and anti-money laundering (AML) compliance, creating a secure and trusted ecosystem. The strategic goal of this framework is to support Qatar's broader national ambitions, including the development of smart cities, the adoption of AI, and the use of blockchain for enterprise applications, all of which are key pillars of Qatar National Vision 2030.2 for MB589 and MG589. This framework provides a clear and direct pathway for market entry. The strategy must be to establish a QFC licensed entity that offers token services for permitted tokens. The pitch should not lead with the XRP cryptocurrency. Instead, it should focus on the XRPL's superior capabilities as a technological backbone for tokenizing assets like real estate, financial instruments, or commodities, all of which fall squarely within the permitted category. 2.2.2 The QIA Mandate, a global diversified investor. The Qatar Investment Authority, QIA, is the nation's sovereign wealth fund, established in 2005 to manage Qatar's hydrocarbon surpluses and diversify its economy for future generations. With an estimated $557 billion in assets under management, the QIA operates as a sophisticated, global financial investor with a more traditional mandate than Saudi Arabia's PIF. The QIA's threefold mandate guides its investment strategy. 1. To create long-term value for the state. 2. To support the development of a competitive Qatari economy. And 3. To provide liquidity to stabilize the local economy when necessary. Its portfolio is highly diversified across asset classes and geographies, with significant investments in technology, media, and telecommunications, TMT, healthcare, real estate, infrastructure, and financial institutions. The fund's leadership includes H.E. Sheikh Bandar bin Mohammed bin Saud Al Thani as chairman, who also serves as the governor of the Qatar Central Bank, and Mohammed Saif Al Sawaidi as CEO. The QIA's investment approach is disciplined and selective, focusing on sectors that are shaping the future global economy. While the QIA does not have any publicly disclosed direct investments in blockchain protocols or cryptocurrencies, its financial institutions investment team explicitly states that it invests in both traditional banks and their fintech counterparts. This indicates that the QIA's strategy for gaining exposure to the digital asset space is likely through investing in the regulated fintech companies that are building on top of the new financial infrastructure, rather than in the base layer protocols themselves. Therefore, a direct pitch to the QIA for an equity investment in a protocol-level entity may be less effective. A more strategic approach would be to first establish a licensed and operational entity within the QFC, demonstrate commercial traction in the tokenization of real-world assets, and then approach the QIA as a proven revenue-generating fintech company that aligns with its mandate to support Qatar's competitive economy. 2.23 The Qatari Fintech Ecosystem, Nurturing Growth. While smaller than its Saudi counterpart, Qatar's fintech ecosystem is actively being nurtured through state-backed initiatives designed to foster innovation and attract talent. These institutions provide a structured and supportive environment for new ventures looking to establish a presence in the country. The central players in this ecosystem include the Qatar Fintech Hub, QFTH, launched to provide a platform of support, resources, and mentorship for startup companies in the financial technology industry. It serves as a primary entry point and accelerator for new fintech ventures. The Qatar Development Bank, QDB, a key government entity that acts as an active investor in the local startup scene, providing crucial early-stage funding and support. 60. The Qatar Science and Technology Park, QSTP,
a free zone and hub for technology-based innovation and entrepreneurship, providing an environment for research, development, and commercialization of new technologies. The local venture capital scene is still developing, but includes active players like 360 Nautica, which along with the QDB, is helping to fund the next generation of Qatari startups. The ecosystem has already produced a number of successful fintech companies focused on areas like mobile payments, QPAY, C Wallet, Buy Now Pay Later, and loyalty program solutions, Spendwiser, demonstrating a clear demand for digital financial services. 61 for MB589 and MG589. Engaging with these ecosystem builders is a critical first step. Participating in a program at the Qatar FinTech Hub or securing seed funding from the Qatar Development Bank would provide immediate market validation, access to a network of local partners and mentors, and a strong foundation from which to pursue a QFC license. This ground-up approach, demonstrating a commitment to the local ecosystem, would significantly strengthen a future investment case presented to larger institutional players like the QIA. Part 3. Navigating Western capital markets, the US, UK, and EU. The investment landscape in the West is fundamentally different from that of the Gulf. While sovereign wealth funds in the Middle East prioritize strategic alignment with national development goals, Western capital markets are driven by a dynamic interplay between venture capital's pursuit of disruptive innovation and a regulatory push towards creating stable, compliant frameworks for institutional adoption. A successful strategy in these markets requires a dual-track approach. One narrative for the venture capitalists funding the future of the internet, and another for the institutions that will ultimately use the technology within newly defined regulatory perimeters. 3.1. United States, the epicenter of venture and innovation. The United States remains the undisputed global leader in technology innovation and venture capital. After a period of significant regulatory uncertainty characterized by enforcement actions, the U.S. is now moving decisively towards establishing clear legislative frameworks for digital assets, a shift that is poised to unlock a new wave of investment and institutional adoption. 3.1.1. The Post-Genius Act landscape, emerging regulatory clarity. The regulatory environment in the U.S. has been significantly clarified by a pro-innovation executive stance and landmark legislation. The current administration has expressed a clear goal of making the United States the crypto capital of the planet, a policy supported by executive orders aimed at establishing a strategic national digital assets stockpile and promoting responsible innovation. The most significant development is the passage of the Guiding and Establishing National Innovation for U.S. Stablecoins, Genius, Act in July 2025. This historic legislation creates the first comprehensive federal regulatory system for stablecoins, addressing one of the most critical components of the digital asset ecosystem. Key provisions of the Genius Act include 1.1. Reserve requirements, mandating that all stablecoin issuers hold 100% of their reserves in highly liquid assets, such as US dollars or short-term treasury bills. Transparency, requiring monthly public disclosures of the composition of reserves, ensuring accountability and trust. 62. Consumer protection, implementing strict marketing rules to prevent misleading claims and prioritizing stablecoin holders in the event of an issuer's insolvency. 62. BSA compliance, explicitly bringing stablecoin issuers under the purview of the Bank Secrecy Act, mandating robust AML and sanctions compliance programs. The Genius Act is a watershed moment, as it provides the regulatory clarity that institutional players have long demanded, thereby de-risking the stablecoin market and attracting significant investment. The next legislative frontier is market structure. The House of Representatives has passed the Digital Asset Market Clarity Act, while the Senate is considering the Responsible Financial Innovation Act, RFIA. These bills aim to resolve the long-standing jurisdictional ambiguity between the Securities and Exchange Commission, SEC, and the Commodity Futures Trading Commission, CFTC, and to establish a clear process for classifying digital assets, potentially through new definitions like ancillary asset. While the final form of this legislation is still being debated, the direction is clear. The U.S. is building a predictable and durable regulatory framework for digital assets. 3.12 Mapping the VC landscape, titans of tech and crypto. The The US is home to the world's most mature and sophisticated venture capital ecosystem, comprising both crypto-native funds that are deeply embedded in the technology and traditional VC titans that have established dedicated crypto investment arms. Crypto-native titans. Andreessen Horowitz, A16Z Crypto. A dominant force in the industry, A16Z Crypto is a thesis-driven fund that has invested over $7.6 billion in Web3 since 2013. Led by founding general partner Chris Dixon, the firm's thesis is centered on backing entrepreneurs who are building the next era of the internet through decentralized technologies. Their portfolio is a who's who of foundational protocols and companies, including Coinbase, Uniswap, Layer 0, and Sui, with recent investments showing a strong focus on the intersection of AI and crypto. Paradigm, a research-driven investment firm co-founded by Matt Huang and Fred Ersum, Paradigm is known for its deep technical expertise and hands-on approach, investing anywhere from $1 million to over $100 million in foundational crypto companies and protocols. Their investment thesis posits that crypto is creating the Internet of Value, a new economic layer for the digital world. Their portfolio includes category-defining projects like Uniswap, Optimism, Flashbots, and Starkware. 74 traditional VCs with crypto portfolios. Sequoia Capital, one of Silicon Valley's most storied venture firms, Sequoia has a long history of backing legendary companies. Their investment strategy is to identify and exploit large existing markets early with disruptive technology, backing founders who offer solutions that are fundamentally different, not just better. In 2022, Sequoia launched a dedicated $600 million crypto fund to formalize its investments in the space. Their crypto portfolio includes companies like Block and Blockade. Despite a high-profile loss with their investment in FTX, which they have publicly acknowledged and written down to zero, Sequoia remains a powerful and influential investor in the technology sector. This ecosystem is further populated by a deep bench of other influential investors, including Digital Currency Group, DCG, Multicoin Capital, Dragonfly Capital, and the venture arms of major exchanges like Coinbase Ventures and Wiseye Labs, the rebranded Binance Labs, all of which are actively funding the next wave of blockchain innovation. For MB589 and MG589, these firms represent the primary source of early-stage and growth equity capital, and the pitch to them must be centered on a bold technological vision and the potential for massive venture-scale returns. 3.2. United Kingdom and AMP, European Union, a tale of two frameworks. While the US focuses on a market-driven legislative process, the United Kingdom and the European Union have taken more proactive, regulator-led approaches to creating comprehensive frameworks for digital assets. Though different in their mechanics, both aim to achieve the same goal: providing legal certainty to foster innovation and protect consumers, thereby positioning themselves as attractive jurisdictions for digital asset businesses